Welcome back to Air Quality Matters and One Take. One Take, my take on a paper or report on air quality, ventilation and the built environment. One Take, in that it's in one take and tries to summarise for you a scientific perspective on something interesting in, usually 10 minutes or less, because who has the time to read all these amazing documents, right? This week, we're looking at something that I think sits at the very heart of the conversation we have on this podcast. It's a question that often lingers in the background, especially when we talk about big investments in building performance. The question is this: does all this effort to make our buildings healthier actually pay off? Is it just a feel-good exercise, a nice to have, or is there a hard, cold financial return on that investment? To tackle that, I'm diving into a really comprehensive document, not a single academic paper in the traditional sense, but a more compelling business case, a compendium of evidence. It's the second edition of a special report from the International World Building Institute, or the IWBI, and the title says it all: Investing in Health Pays Back. Right off the bat, this report sets out to prove its title. And I have to say, it does a pretty convincing job by putting together a huge amount of research, from academic studies to industrial reports, into one place. It builds a layered argument, and that's hard to ignore. So, where do we start? I think the most powerful place is with the concept that fundamentally reframes the entire debate around buildings costs. You may have heard of this before, and particularly if you heard the Joseph Allen podcast we did earlier in the summer, something called the 330-300 rule. But the version in this report is even simpler. It's the 99-1 rule, but basically the same thing. Think about the typical costs for a business operating in an office. Over a year or a decade, about 1% of their total cost is energy. Just one. About 9% is the cost of the real estate itself, the rent, the lease, or whatever. And the other 90%, well, that's the people, the salaries, the benefits, the human capital that actually runs the business. 90%. For decades, the green building conversation has been, let's be honest, overwhelmingly focused on the 1%. We've spent enormous effort trying to shave 10% or 20% off of that 1% slice of the pie. And that's important, don't get me wrong, especially for climate change. But what this report argues so effectively, as does the case from Joseph Allen, is that we've been looking through the wrong end of the telescope. If you can make an intervention that improves the performance, the health and productivity of that 90% slice, even a tiny fraction, the financial return absolutely dwarfs any potential energy savings. A 1% gain in productivity is financially equivalent to wiping out the entire energy bill. It moves health from being a cost center to a strategic investment in the company's most valuable asset, its people. So, with that framing in mind, the report then drills into the evidence. And it splits it into a few key areas. First, there's the impact on healthy people and healthy organizations. This is the direct effect on that 90%. The report cites some really powerful studies. One of the most famous, of course, is the Harvard Cog Effect study that found enhancing indoor environmental quality, better ventilation, lower VOCs, can boost cognitive function scores. Now, what does that actually mean? It means people can think clearer, make better decisions, and be more creative. That's a direct line to improved productivity. The report quantifies this, suggesting higher ventilation rates alone can increase employee productivity by between $6,500 and $7,500 per person per year. When you scale that up across an organization, the numbers become immense. And it's not just about productivity gains, it's about loss mitigation. The report talks about absenteeism, people not showing up for work, and perhaps more importantly, presenteeism, which is when people are physically at work but are too unwell or distracted to be fully functional. Poor indoor air quality, bad lighting, thermal discomfort, all of these contribute to that. By creating healthier environments, you directly reduce sick days and improve focus, chipping away at those hidden costs. The second layer of the argument is the building owners and real estate investors, the people concerned with that 9% slice of the pie, I suppose. The report presents clear evidence that healthy buildings command a premium. One MIT study it highlights found that buildings with healthy building certifications, like WELL, achieve effective rents that are between 4.5% and 7.7% higher than their non-certified neighbours. In fact, we covered this on a previous episode of One Take. Not only that, but they also secure longer lease terms, on average over a year longer. Now, for a real estate investor, that's a double win. You're getting more rent and you're reducing vacancy risk and the transaction costs of finding new tenants. This shows that the market is beginning to price in the value of health. Tenants, especially top-tier corporate tenants, in their war for talent, are actively seeking out and willing to pay more for spaces that support the well-being of their staff. The report also touches on specific tangible strategies, things like biophilia, the integration of nature and natural elements. It's not just about putting a few pot plants on a desk, it's about views of greenery, natural materials and patterns. Studies cited show that can improve mental health and productivity. The same for daylighting. Giving people access to natural light, this is linked not just to better performance at work, but better sleep at night. It's all interconnected. Finally, the report brings this all in to a modern world of finance, especially ESG, environmental, social and governance. For a long time, the E has gotten all the attention, but now the S, social, is becoming understood and financially material. How a company treats its employees, its customers, and the communities it operates in has a direct impact on its long-term viability and profitability. And this is where it gets really interesting. The report details how health and well-being metrics are being integrated directly into financial instruments. We're seeing things like sustainability-linked loans and social bonds where the interest rate a company pays is literally tied to them achieving certain targets. And one of those targets can be achieving WELL certification for buildings. This is ultimately proof that investing in health pays back. The financial markets themselves are starting to reward it with cheaper capital. So, to wrap this up, what's my one take on the report? The main takeaway for me is that the business case is no longer theoretical. It's robust, it's quantified, and it's being proven in the real world. There's still work to be done, don't get me wrong, but the conversation has fundamentally shifted from seeing a healthy building as an expense to seeing it as a return on investment. By focusing on the 90%, the people, we unlock value that is orders of magnitude greater than focusing on the 1% of the energy costs. The benefits flow to everyone, to the broader economy through increased GDP, to organisations through higher productivity and talent retention, and to the real estate owners through higher rents and asset values. This report from the IWBI is a powerful tool, I think. It's a clear evidence-based argument that's really well put together, that aligning our built environment with human health isn't just the right thing to do, it's the smart thing to do. It's a strategic imperative for any forward-thinking business. Thanks very much. This has been this week's episode of One Take. This podcast is not possible without our sponsors, Safe Traces and Imbiot. So thanks a million to them, and I'll see you again next week. See you then.